Hello and welcome to the Daily Brief Show by Zerodha. Here we cut through the noise and bring you the most important stories that move the markets. Today is the 9th of August and I have 3 interesting stories for you. In the first story, we'll talk about the unsecured loan crisis in India. In the second story, we'll continue from where we left off yesterday and talk about the food inflation in India. And in the third story, we'll look at why Reliance is reducing its employee count. So let's begin. The RBI policy meet happened on Thursday and the governor Shashikanta Das made many interesting statements. But the one thing that stood out was his comments on unsecured loans and personal loans. He said, and I quote,
"The sectors in which preemptive regulatory measures were announced by the Reserve Bank in November last year have shown moderation in credit growth. However, certain segments of personal loans continue to witness high growth. Excess leverage through retail loans, mostly for consumption purposes, needs careful monitoring from macroprudential point of view. It calls for careful assessment and calibration of underwriting standards as may be required, as well as post-sanction monitoring of such loans."
Now look, we are in the middle of the earnings season and pretty much all the major banks have announced their results already. There are some interesting developments here regarding unsecured and personal loans. But before getting into that, let me give you a quick overview of the overall credit growth in the banking system of India. See, overall credit growth was pretty steady at around 15% year on year in June, while deposits were growing at 12% year on year. A few weeks ago, the RBI governor expressed concerns about this gap between the rate at which deposits are growing and loans are growing. If you break down the credit growth, some interesting trends emerge as well. Retail lending as a whole is growing at 17% year on year and has moderated from well over 22%. But what is happening with unsecured lending is quite crazy. See, around the same time last year, unsecured loans were growing at well over 30% year on year, but now they have fallen to 15%. This shows the extent to which retail lending has taken off after the pandemic, but now the growth is slowing down thanks to some measures that the RBI has taken in November 2023 and also the fact that RBI has repeatedly expressed concerns over unsecured lending growth. Now talking about banks, I won't throw around numbers because I don't want to bore you, but I'll just highlight the directional trends. See, if you look at the results of private banks, some of them are starting to see some stress in unsecured loans and credit cards. Axis Bank saw an uptick in its non-performing assets and 88% of the incremental bad loans or slippages were from retail loans. RBL Bank saw an uptick in bad loans as well due to some stress in credit cards and microfinance. Federal Bank also saw a bump in bad loans in its retail lending book and so did Kotak Mahindra Bank. Now Kotak Bank said that some small ticket consumers, retail and unsecured loans went bad because some of these customers were taking multiple loans from different lenders. Among PSUs, Central Bank, Indian Bank and Bank of India saw some stress in their unsecured and retail loan books as well. So what is happening, you might be asking? See, it's not clear if there is a huge retail loan problem in the Indian banking system. Some of the stress has only shown up in the last 2 quarters alone, so we don't have a lot of data yet to back it up. You also will have to consider the fact that during the last quarter, there were elections in India and severe heat waves as well. There might also be some seasonal effects at play here. Now, some experts have pointed out that small retail loans under 50,000 rupees may be in a bit of trouble. These loans have grown at a spectacular rate because they tend to have higher interest rates and banks are working hard to improve their margins here. Now, there does seem to be a cause of concern about these loans if you look at the recently released RBI Financial Stability Report. See, the RBI said that in retail loans, fintech lenders, especially NBFCs or non-banking financial companies, had very high delinquency rates of 8.2%. To give you some context, the total gross non-performing asset ratio of the overall Indian banking system was at 2.8%. But these small ticket loans are not a system concern. India Ratings and Research Company recently pointed out that loans under 50,000 rupees account for only 0.4% of the total outstanding retail loans. They further wrote, and I quote, "Overall, the asset quality of outstanding credit showed an improvement on a year-on-year basis in FY24 except for personal loans. Credit card asset quality broadly remained the same. Delinquency levels remain low across product categories with the share of low-rated borrowers, which is below prime and new to credit borrowers, in incremental credit continuing to decline." So why is the RBI really worried? See, maybe the RBI is just being cautious or it is seeing something that we are not seeing. It could also be the case that certain segments of consumers are borrowing money to finance consumption because the rural economy has been in distress lately. And like I have mentioned on the show many times before, there has also been heat waves, poor monsoons, layoffs, and bad employment growth. I guess we'll just have to wait and see if unsecured retail loans do become a systematic issue in the future. But moving on, remember yesterday I had spoken about the changes in the weightage of food in India's CPI basket? In case you missed it, no worries. Let me give you a very quick recap. See, the Ministry of Statistics and Program Implementation is considering changing the composition of India's CPI or Consumer Price Index basket. This is because India's current CPI is based on data from back in 2011-12 and still includes things like horse cart fee and video cassettes, which are obviously very outdated. The CPI basket, for your context, is a giant basket of things, 299 items to be very exact, which Indian consumers consume regularly. Inflation is calculated by looking at how the price of this particular basket changes. But the thing is, inflation is a bit of an arbitrary number. All of us have different consumption habits and not all of us consume all 299 things from the basket. So therefore, in reality, the same inflation number may not quite apply to all of us equally. But one consumption habit that is almost certainly common to all Indians is food. See, food along with energy is also the most volatile segment when it comes to inflation. If you think about it, the business of food is literally about growing living things. So there are multiple variables associated with its production and consumption as well. So that is why it's interesting to study food consumption separately and not really a part of the overall CPI basket. See, the ratings agency CRISIL releases a monthly report called Rice, Roti and Rate. The report calculates the average cost of preparing a vegetarian and non-vegetarian thali that an average Indian consumes. This includes cereals, pulses, chicken, vegetables, spices, edible oil, and also cooking gas. So this is basically a good representation of how India eats. And since it factors in the rise or fall of prices of anything and everything that goes into our food plates, it is probably also a good indicator of food inflation. In June to July 2024, the food plate cost for a non-vegetarian has increased by 6%, but for vegetarians, it increased by 11%. The rise in veg thali prices were due to the rise in prices of tomato, potato, and onions. Month on month, tomato prices rose by 55%, onion by 20%, and potatoes by 16%. Tomato cultivation was badly affected by the heat waves that ravaged India, especially key tomato growing regions like Karnataka. Same was the case with onions. Potato harvest, on the other hand, was affected by a disease infestation this year. Now, while the report does not explicitly mention it, it indirectly points to several important trends and factors that affect how we consume and how much we spend on it. The first is the stubbornly high food inflation that has been leading to a steady increase in prices of key food items. This year, food and beverage inflation has consistently remained above the 7% mark since January. In fact, in the last month, the food inflation accelerated as well. This is despite the fact that core inflation, which removes food and energy, is at record lows. The sticky food inflation is the key reason why the RBI also did not cut rates yesterday. The second is that the report puts a rupee value on the impact of abnormal and brutal heat waves caused by climate change. See, when we think about climate change, we often think about temperature, pollution, etc. But it directly hits us where it hurts, which is our wallets. See, as climate change worsens, our food supply systems will be pushed to the brink. Crop failures, pest infestations, shortages, nutritional deficits, and other serious issues will become much more common and severe because agriculture will be one of those areas which will be hit the hardest by climate change. Now, moving on to the third and final story for the day, we'll understand why Reliance is cutting its employee count. See, yesterday there was a lot of noise on the internet about Reliance reducing 11% of its workforce. People naturally assumed that this highlighted the unemployment problem in India. See, Reliance, for your context, is India's largest company in terms of market capitalization. So if Reliance is hiring or firing people, it matters to the overall economy. So what is happening really? Let me tell you. See, according to their annual report, Reliance's employee count has decreased by more than 40,000 this year. And that is about 11% of their total workforce. Now, while the number of employees in Reliance oil to chemical and exploration and production business has increased, the number of employees working in Reliance Jio and especially in Reliance Retail has significantly decreased. Therefore, most of the job cuts were in Reliance's consumer businesses like Jio and Reliance Retail. Interestingly, the drop is not because of layoffs though, as most people may naturally assume. Two things are happening here. First, there is a lot of attrition, which means a lot of people are leaving on their own. And second, the number of new people being hired has come down. I'll explain. See, in 2022-23, Reliance hired about 260,000 new employees, but in 2023-24, they hired only 170,000 people. If you compare the data for both these years, Reliance's attrition rate has not quite changed significantly. Now, this could signal a real shift in their hiring strategy. The most likely reason for this is that most of Reliance's newer business initiatives like Jio and retail are now maturing. For your context, Reliance Retail currently employs about 60% of the company's total employees and Jio employs about 25%. And these both numbers are much more than the number of employees in Reliance's mega oil to chemicals business. Now, whenever businesses start to move from hypergrowth stage to maturity, they usually go into an autopilot mode. Therefore, it is very well possible that Reliance no longer requires so many employees for its consumer businesses at all. A drop in employee count by more than 10% could also mean that Reliance is temporarily shifting its strategy from making newer business investments to now using its position to establish a much stronger footing in the market. So while they're not quite firing people, they're also not aggressively hiring. An analyst that the Economic Times spoke to said, and I quote, "The new lines of businesses have matured now and have significant support from digital initiatives. Now they are at a stage to better manage operations with optimum strength. It doesn't mean that the numbers won't increase when new business opportunities emerge and strategy changes. They understand very well how to drive cost management and efficiency." Unquote. But all that said and done, this is only an estimate based on 1 year's data. This is likely the start of a larger trend, but it could very well end up being a one-off case scenario as well. I thought of covering this story just as a food for thought, and I would love to know your thoughts in the comment section. That's all the news I have for you today. I hope you found value in today's episode. I'll see you tomorrow. Take care and goodbye.